All right, survey's been fixed, so welcome everyone. Thanks for coming out for week 4. I know midterm season started, so it's great to see everyone here. We're going to cover some stuff today that's pretty cool. I think you guys will enjoy it. And also one thing that happened is that we got some feedback. We'll try to keep it a little bit less technical from here on onwards for now. But we also do have Solidity workshops that we've done in the past that were free scheduled, depending on how people like it and how people are interested in it. So we're kind of free to go more technical, but for now, just to keep everyone kind of caught up, we'll keep it a little bit high level for the next, I guess, little bit, and then just make sure we're at a good pace for everyone. The survey is up here as well, so if you haven't filled it out, it'd be good to fill it out. Just gives us some feedback on the type of lectures you guys like to see. And there's also if there's some stuff you guys might have found was a bit too technical or a bit too sort of not what you think would be, that didn't really fit you that well as some stuff that you think you enjoyed so far, so we can kind of keep drilling in on what you guys actually really enjoy in the space and keep having a good time. Likewise, we'll also have some stuff out, if you want to talk to us afterwards on specific interests, happy to do so. Otherwise, we'll get into this week's presentations, which will be on stablecoins. So, end of last week's presentation, we covered decentralized exchanges a little bit, specifically Uniswap, which is the largest decentralized exchange and also really the first one that took off in the ecosystem of blockchains. And within that, Ethereum itself, as it was built on Ethereum. Now this week we'll be talking about stablecoins. As you can see, there's sort of a pattern here. One of the nice things about talking about decentralized finance is that there's a few core components that are able to be decentralized and also fit together in this ecosystem. Decentralized exchanges allow you to, without having to give up your assets to any other counterparties, trade your assets. Now stablecoins are here to actually give you some sort of tokens that are stable in value without having to make the same exact trust assumptions as you would for other tokens or even just dollars in a bank account. So this week we'll explore how stablecoins work, some different models, and also just high-level stuff from an economic perspective on what stablecoins are actually attempting to achieve and recent historical attempts in this space. So yeah, obviously the idea of a stablecoin is to have a stable value. One of the things why this was revolutionary in cryptocurrency is that cryptocurrency itself, being a decentralized network, actually has no sort of tie to the outside world's monetary policy directly. As you guys know, with Bitcoin and now with Ethereum, they have their own native token, either BTC or ETH in Ethereum's case. As a result, these tokens have their own supply issuance mechanisms. For most of their history, it was just Bitcoin mining or Ethereum mining. As a result, you basically, the protocol pays the miners, or it pays the entity that finds the next block in the consensus algorithm. And this consensus algorithm is permissionless and decentralized, so anyone's able to join and become a miner on the network. This is also one property that was core, it is core to cryptocurrencies itself, is the decentralized nature of letting anyone be a validator and having a trustless execution model where you don't actually have to trust that these executions happened by hearing from someone else who can actually look at the direct data itself and look where and when and exactly who sent these transactions to give a sort of transparency to the blockchain and allow for a new type of coordination mechanism, this time around money, and with Ethereum's case, programmability. So with cryptocurrencies, one issue is that they're not price stable. As you can see with Bitcoin and Ethereum, they are essentially network tokens, right? Because they are the native token of an underlying blockchain network. As a result, people can speculate on these tokens. They'll go up in value. They have no core mechanism to stabilize the price. And this is often actually a good thing, because if we try to stabilize the price of Bitcoin or Ethereum, we would probably just be pushing the problem elsewhere, such that in cases where if you try to stabilize something here, you might actually just force the volatility elsewhere. So by having the network token itself be volatile in price, we get a network that's that people are able to buy into, speculate on, and also be a participant in. But holding your value or your money in the form of these tokens is a bit sort of risky, because one day you might wake up, and from minute to minute the value will change from the value, in your value that's stored on these decentralized networks. So as a result, the idea of the stablecoin is to have the decentralized network properties of blockchains, but also have the price stability of the dollars in your bank account. And this is the whole idea of stablecoins, and we'll sort of approach this from a monetary perspective. So why stablecoins? Again, like I mentioned, this decentralized governance structure. A lot of these cryptocurrency protocols themselves have their own way of implementing network protocol upgrades, as well as how the transactions actually execute. For example, if you want to send money right now electronically through two bank accounts, you can use a wire system. There's domestic wires and there's also international wires, which are processed by two different systems. But they're essentially gated systems. You for the most part just send a request to your bank, but it's actually the ones doing the operations behind the scenes, and you really get no guarantee or any way to look into what's going on. You just get a guarantee from your bank or just an order saying we'll process this by tomorrow or by some point this week, and this is kind of all you know. But in the stablecoin space, the network operation at the fundamental level is actually open and transparent, and as a result, you can see everything that's happening behind the scenes. The issue is that, again, right, you actually have to have a price stable token in order for you to actually be comfortable in holding your value anywhere. This is one of the reasons why we have these stablecoins, to take advantage of these properties. And so the stability is actually sort of a idea that's really hand-wavy, because we're used to in our day-to-day lives, especially by living here in the U.S., having a reliable currency we can sort of depend on from month to month, year to year, decade to decade. Of course, we have inflation with the Federal Reserve. They print money, et cetera. There's a target of 2% inflation per year. However, we are, in general, protected from most of the issues of price stability, for the most part. Again, right, like sometimes we might get affected by the prices of gas, but these are usually just effects on one sort of commodity. That's more so the exception than the rule. Of course, this past 2 years, we've seen quite a bit of increase in inflation, which is sort of the first time in the general consciousness we can start thinking of price stability as a global and sort of external macroeconomic issue. But the idea here is that you want something, if you're using it as a currency, to be stable against everything else. We have pretty efficient markets here in the U.S., so a lot of the prices are already at the point of most efficiency. The issue itself now really just comes down to the base unit we're measuring in, which is in this case the dollar. One other thing to think about when you're thinking about price stability is how the performance of other currencies do, specifically ones issued by other central banks in other countries. I'm sure you guys have heard recent performances. The Turkish lira was pretty popular, in the news last year. Japanese yen is pretty sort of in the news this year. But as you can see, sort of the base unit of currency issued by these countries is sort of a measure of their economic outputs and their monetary policy. And it actually calls into question, if you're holding some sort of currency, what is the actual value derived from, and where does the actual sort of ball headed in terms of their planning and how they're sort of mechanized. So the core issue, or the core idea, or the core mechanism here we're talking about is really just supply and demand. From microeconomics and just economics in general, you look at supply and demand itself. It's for currencies, they actually have their own version of supply and demand, and it's always there. It's just that if you take a currency as the base assumption, saying, okay, we'll look at other things priced in terms of this currency, you actually miss out on a layer of the abstraction, or you don't see one of the layers of the abstractions. Currencies themselves, when they're used to measure other things like commodities or real estate, have a good use in measuring supply and demand. But if we take one step back from that, we actually can see the supply and demand on currencies themselves, which follow the same exact behavior of supply and demand that's exhibited on other goods and services in terms of the price. The demand for the currency obviously has its own function. The supply of the currency has its own function, and they meet at some equilibrium, which is the current market state. If there's some sort of disturbance, say the supply increases in the currency because of Federal Reserve actions or central bank actions, it will have an effect on the sort of price level of all the price level of the currency itself. And the reason why this is a bit of an inversion, or it's an abstracted inversion, is that the supply of the currency increases and the price level of the currency itself goes down, you see it reflected in the economy as an increase in just prices of goods and services. However, that's actually not what's going on in real terms or in economic real terms. If the supply chain of bananas wasn't directly affected and everything's still working at the same efficiency and somewhat the same process, but the currency itself used to measure bananas has changed. Now you see the difference of that reflected in the price, but oftentimes it's misconstrued as, oh, the prices of goods and services are going up, but in fact, the actual price level of the currency itself is going down because of this upward sloping supply curve. So just one thing to keep in mind whenever you're hearing about stuff in the news. Oftentimes, right, a lot of it is just a lot of it's just directed, not focusing on this core idea. That's really quite important when you're talking about any type of economic policy or any type of actions within the space. So I mentioned we'll keep it a little bit non-technical, so we're going through a bit of a monetary policy direction this week. Bretton Woods was by far the most impactful event of the 20th century and of the past 100 years when it comes to money. The Bretton Woods Conference, for those of you guys who like history might know, was the conference after World War II that essentially came and put together all the winners of World War II and restructured the world order. One thing about having a very global interconnected economy is that you need some sort of currency to trade in, and just like having a common language, having a common currency or a lingua franca makes things much more sort of low friction and thus more efficient in terms of having trade opportunities for like individual people or individual agents in the market. As a result, the Conference of Bretton Woods was held to determine a few things, but specifically that the U.S. would be now the world's reserve currency with the U.S. dollar. They would be managing the world's reserve currency, and they would peg the USD to the gold standard. And the gold standard in this case, right, just for to take another step back, why do we think the USD is valuable? Why would they, have some sort of management of the currency? Well, there's benefits of having fiat currency or paper dollars compared to just moving bricks of gold around, because gold is heavy, and if you lose it, it's gone, et cetera. But having some sort of central bank managed currency has this advantage, but there is a sort of a departure from the real value of gold, right? But then again, where does gold have retained its value from? It's again the social consensus. It's historically and culturally one of the most long-standing valuable currencies that has scarcity throughout thousands of years of human society. As a result, they said, okay, we'll just follow the gold standard. We'll have some sort of backing for the dollars we issue, and we'll keep it in a fort in Fort Knox or wherever. And you can just trust us if you guys want to redeem it. The Chancellor of the Exchequer will call us from Britain and say, hey, we want to redeem 10 trillion pounds or whatever, maybe 2 trillion these days of gold, and then we'll just ship it over, or we'll just write a contract that issues someone else as a new owner of these bars of gold that we hold in a gold reserve somewhere. As a result, pretty efficient system that defined the next sort of from 1945 till now, so about 80 years. Yeah, about almost 80 years now. But things don't always go to plan, and as a result, we had the Nixon shock, which was mostly results from the spending efforts of the government with the war efforts in Vietnam. Essentially, what was going on was that there needed to be a mechanism to pay for the war efforts at the time in the 70s, which this was going on. As a result, the government can just keep borrowing money by borrowing from the Fed, which will print the currency. But as a result, obviously, you can't just make value out of nowhere. The sort of cumulative gold backing as a proportion to the outstanding dollar supply will go down, making the currency less valuable, right? And this is clearly not good for people or for central banks who are holding the dollar. You can kind of start to see where people are getting a bit shifty about this, because there's, specifically at the time it was Spain and France that looked at this, and they themselves, being sort of gone down the road of being broke from wars, looked at this and saying like, hey, we kind of see where this is headed, and we're not really having faith in your dollar anymore, because you're obviously a bit too far deep into whatever you're doing right now, and you're kind of passing the cost on to everyone who's holding your dollar because you're managing the world's reserve currency right now. As a result, they started to get, make a few phone calls, get a bit restless, and at the time, Richard Nixon was the president, and he really had to do something because there really was going to be sort of a collapse or a larger meltdown if nothing was to be done during this time when countries were considering going off the dollar or at least doing something about this gold standard. As a result, what he did was for 90 days, he issued an executive order that just canceled all redemptions of gold for the dollar, and then as a result, the dollar actually became floating, right? And this is actually where we get the term for fiat currency from, is that in fiat, right, fiat just means free floating, I believe, in Latin. It's been a while, but the idea that a fiat currency is actually unbacked, whereas previous to this, the dollar itself was backed by gold. In the fiat case, there's actually no backing to it, and it plays by a different sort of set of standards, right? As you can see, this would actually cause some sort of big disturbance in the way the economy works, because now the rest of the world doesn't actually have any gold backing to the currencies they hold in the central banks of their countries. But what actually happened was it was fine. There was actually no issue, and the kind of world resumed back to what it was doing. Some theories to this suggest as wise because at the point the dollar was already such highly integrated into the economy of the global economy in terms of trade that it wasn't really much of an issue. And there's also the issue of oil, which is kind of a whole separate topic, but we won't get into that today. Anyways, we will also just take a look at this in general, right? Like you can start to see central bank issued currencies as their own sort of ecosystem, right? You have stablecoins, but now you also have traditional central bank currencies, traditional fiat currencies, which have trading pairs against each other. And so the trading pair in this case would just be two currencies which are being traded against each other. And generally, the strongest currency is used as a barometer to measure against weaker currencies. Note that the price level, or actually the unit bias, or the actual like number of the units of currency, doesn't necessarily mean which one's strongest, right? Like for example, the pound is a bit more valuable than the dollar right now on a one-to-one basis, but that doesn't mean the pound is necessarily stronger. It just means on a unit bias level, 1 pound is worth more than $1 on the open market. But there's obviously there's more dollars in circulation, and so you can sort of kind of look at this as market capitalization versus price of a stock, right? Just because a stock has higher price doesn't mean it's more valuable than something else. If you want to look at actual sort of total wealth or value stored in the system, a better proxy metric is market capitalization, and in this case, a better proxy metric is just the total circulating supply of the currency measured against the assets of the central bank that issues that currency. And also, kind of cool tables. You can see these major pairs of currencies. Again, right, these are like G7 currencies. Winners of the Bretton Woods Conference, in another word, another saying. And then also, yeah, it's actually, a lot of this ties into history. There's also these cross pairs, which are sort of, your altcoins, are the currencies that aren't really necessarily used as much as these major pairs are used for in major economic activity between major powers. And also exotic pairs, or sort of, like jumpstart or like startup countries. Not literally, but they're just like less, maybe less favorably rated by bankers who are trying to, who specialize in sort of stuff in this sort of, sort of industry or subsector. The actual managers of the treasuries, the people who manage the financial institutions, et cetera, et cetera. So it's really just a way to look at traditional currencies as just one other form of currencies in general. And so we look at the cryptocurrency scene as a nascent version of the traditional currency scene as a whole. Obviously, the parallels don't always exactly transfer, but you get some sort of parallel here that gives you somewhat of an understanding against how these other tokens are measuring up. With Bitcoin being the first, strongest, largest, and also now most widely adopted cryptocurrency, it's used as a base trading pair, especially on Binance, where a lot of this stuff is important. And this is actually on the screenshot on the right. These prices are a bit stale, and also these tokens are also a bit stale, but you can see actually how the idea is that at the base currency level, some people want to hold some sort of strong currency. If you don't trust Litecoin, if you don't trust, like EOS a lot, right, and you think it's like, well, we don't know how this coin will do in the long term, you want to get back to some hard money, you would look at Bitcoin as being the base pair. that is actually the one that's being held for long-term value and why it's used as the base trading pair overall. Again, you look at reserve currencies, just sort of a perspective on the larger ecosystem, right? The reserve currencies are just today's fiat version of stablecoins. They're currencies printed by institutions trusted enough that they will hold their value for the indefinite future. Obviously, you wouldn't hold dollars if you don't think dollars held their value, but obviously we can see from this chart here that the trust in the dollar is quite high just by where people hold their money. And you can also look see a lot here a lot of other G7 economies, as well as some other other economies that are becoming more and more important in the current financial sort of standing of the world, as well as trade. But again, you can just think of these currencies as something that is issued by a central entity that is tasked with the responsibility of managing these actual these currencies. One other topic I think is really quite important here when we're talking about money in general is the special SDRs. So the special drawing rights is a mechanism designed by the IMF, which is the International Monetary Fund, which is sort of an agent that's independent, formed of, I think it's G5 or G7 countries, G5, yeah. It's formed of 5 of the most important important countries in the world's reserve currencies. As a result, the IMF is a body that's also designed to help coordinate different large economies into the sort of management of the world economy in terms of trade and currency. The SDR here is a special sort of currency or a unit of currency created by the IMF that operates as sort of a supplement for other currencies, for example, that want to start off with and they want to have some sort of backing that's not necessarily tied to just one central bank in one country, but in fact is actually more like a basket of currencies that represents the sort of global economy a bit better. As you can see, this is the 2015 weightings. 1 SDR equals this. You can't actually trade the SDR anywhere because it's only redeemable through the IMF, and so the people who actually hold these SDRs, these notes, are actually just, they have direct relationships with the IMF, and they're actually, it's not designed to be sort of a going around currency or a spending currency, but more as a tool for monetary policy for central banks who are interested in actually holding on and managing their reserves in a responsible fashion. And so the technical details behind the currencies themselves, right? So on a very basic level, the currency is valuable for what you can get for it, right? It's just numbers at the end of the day, but the actual value comes from its participation in the actual economy. These currencies traditionally have been printed by the central banks. For the euro, we have the ECB. The U.S. has the Federal Reserve, and in the Hong Kong case, you have the Hong Kong Monetary Authority. And these are actually kind of, these are more of the free market sort of schools of thoughts behind their currencies themselves. These are all free. Actually, I don't know if the Hong Kong dollar is still floating. I don't know if actually, but anyways, sometimes central banks will actually peg their dollar against another currency. For a long time, the pound was actually, or for a while, the pound was pegged against the dollar, I believe, which led to the George Soros thing, which was what happened when he shorted the pound and ended up just buying it back after it broke the peg, causing sort of an economic crisis. But this is what you do when you sort of have a poor stablecoin mechanism. So again, these are some sort of things to consider when you're looking at sort of the high level of the global economy and sort of the piping that runs underneath it and how everything kind of fits together. So the role of the central bank here, or the monetary authority, it's an institution that just manages the state currency, right? And the currency on a business level or on a real level is just the liability side of the balance sheet from the central bank, right? The central bank itself has assets, and so these assets are usually held in terms of either gold, other central banks' currencies, or like actual stocks and bonds of the internal economy itself. For example, in the Fed's case, if they actually did something during COVID where they directly bought bonds issued by companies in the U.S. In order to lend them or inject money into the economy, what this essentially is doing is Apple will issue a note for maybe say $1 billion, and then we'll go to the U.S. They'll go to the Treasury. Well, actually, it goes to BlackRock, but they go to these institutions and they borrow. They sort of lend. They borrow money from the Federal Reserve And as a result, it gives the Federal Reserve as central banks a way to sort of stimulate the economy through these direct actions. These new dollars which are printed into the economy are now held by these companies, but the actual way it shows up on the balance sheets is that now the Fed actually has its own balance sheet, and it issues liabilities against the assets it just bought, in this case corporate bonds, for the actual currencies it prints, and then the currencies go into circulation on the balance sheet of these companies, and then from there they find their ways into the hands of everyday people, et cetera, et cetera. You can sort of see how things start to fit together on a higher level basis from central banks to the rest of the sort of economy. And then one other thing to look at this is just the idea of monetary supply. So again, these are just measuring tools, but they're so well used and so sort of crucial infrastructure that they are, again, they sort of have value in and of itself. The Fed's balance sheet is roughly $8.82 trillion as of this week. So again, pretty big, right? Larger than any one individual's persons of wealth by orders of magnitude, several orders of magnitude. There's no trillionaires yet, although we might see that in our lifetime with the way things are going. But you can look at the sort of definitions of money here. The world's collective monetary supply in terms of broad money, which is just actual physical cash and also debt, is roughly $95 trillion. This doesn't include money held in sort of like market capitalization structures, such as real estate or stocks. Actually, no, I think they do. So they do count that in terms of all broad money. Anyways. But yeah, you have broad money, which is actually the total definition of wealth, and you have the narrow money, which is a different definition, which is I think that's the one that only includes debts and deposits at banks. But anyways, yeah, you get you get sort of different layers to this, and the way you sort of start counting wealth or counting money actually matters to economists, which look at this and they see, okay, well, how can we actually manage our economy depending on how much perceived wealth we think we have in our nation or our state, and then as a result, you have sort of a different measuring stick or a piece of data input that's now being used to help set monetary policy for the future. Again, these are very high-level concepts that are sort of the setting we're in. These aren't really the mechanisms that they exactly quite use. If you look at the FOMC, the Federal Open Market Committee's meeting notes every 2 months, you'll actually see what their plans are and like what their justifications for them, specifically being, hey, we saw an uptick in this statistic or this statistic, and oftentimes they'll just actually say their actions. Specifically saying we're continue lending, or we'll stop issuing some notes at some rates in order to what they believe be lower or increase the velocity or sort of the supply of money in certain areas in order to, one, as the mandate, manage inflation, and two, manage unemployment, which is the second reason for the Fed's mandate, which is why sort of the whole system exists in its current state as sort of the justification for all of it. But yeah. That's sort of the monetary things, and then we're also going to look at sort of the securities side of things, which is also important because securities themselves are sort of the financialization of all these economically productive goods and services, although sort of the securitization or the financialization of these actual goods, services, contracts, et cetera, are sort of more of a spectrum. You can have low, like no securities, which is you're just bartering. You can have extremely securitized or financialized products, such as mortgage CDOs, which we all looked at as sort of the cause of the 2008 crisis. There's really a spectrum here. Essentially, it's just contracts on top of contracts that resolve in different layers of settlement that give value based on perceived future cash flow and also current, like net present value of this future cash flow. That is sort of represented by the security, as well as other market risks that are priced in, such as the currency risk, the actual, like centralized, like the risk of it defaulting, et cetera, et cetera. So there's a lot of things here when it comes to securities that, are taken into consideration, but they really make up for a lot of the day-to-day financial life we sort of participate in on the stock market, putting money into your bank, et cetera, et cetera. Also, one point that is pretty important to mention with securities is in the US, the SEC, Securities and Exchange Commission, is an independent federal government agency responsible for protecting investors, according to the mandate, among other duties. So it was actually created in 1934 as a response to the Great Depression. It's kind of funny because it took like 5 years to come together, but it's better they do it right than not do it at all. But it's funny, right? Because it's But anyways, it was actually created in specifically in the Securities Act of 1934. It's 34, 44, and 45 that were the three major securities acts that were sort of foundational for our current securities laws in the U.S. today. But as you can see, this was like mid-20th century. Now we are like early 21st century. In roughly the 80 years since this has happened, you don't actually get, the regulations moved quite slow. And this is partially a result of the federal body itself being a bit conservative with their actions. They don't like to, right? Like for them, they are sort of the highest law in the land when it comes to securities, like regulation and legality. If they move too quick, it gets in a gray area. If they don't move at all, it's another gray area. Or if they move too quick, there's repercussions. If they don't move at all, it's just a gray area. But the SEC itself currently does a thing called regulation by enforcement, which is sort of the most gray area thing you can probably do, which is these publish some rough guidelines, and again, federal bodies themselves are separated by the way the Constitution is written. There's a separation of powers, so it's not like the SEC doesn't actually work in lockstep with other federal bodies. It's kind of its own federal body, which is why we see different sort of commissions or like federal bodies that manage different parts of the economy in terms of regulations. But the SEC itself does a thing called regulation by enforcement, which is they'll just come after like people for what the SEC deems to be not kosher according to the regulations. But as a result, the only way the SEC actually takes enforcement is by bringing this to court. So as a result, if you ever see the SEC in the news, right, they just go after, like, the way they do enforcement these days is actually just by court, which is quite people call it it's kind of a regime these days, because you really can't do much by the point you're in court. It's already a lawsuit, and you're already in proceedings, versus in the other cases where if there's guidelines, it's sort of much more defined on intended behavior or incentivized behavior, which is sort of it's a kind of an inefficient model that has really been the basis of a lot of frontier industries, but also cryptocurrency itself, because it's so financialized in a sense. Anyways, so moving on from the SEC, we'll talk about Tether for a bit. So Tether is the first, and Tether itself being the first well-known stablecoin is a great sort of reason why this is all here, because so Tether itself being the first well-known stablecoin, actually, I can fix this. Okay. Tether itself being the first well-known stablecoin starting in 2015 really sort of bootstrapped the cryptocurrency space in terms of a stablecoin itself that can be traded. Before Tether, there really wasn't much of a well-adopted stablecoin that you could hold your crypto assets against. If you had Bitcoin, you really just had to hold Bitcoin or find someone to sell it to in cash. There was exchanges that like Mt. Gox, which was a form of crypto exchange, that you could just go to and just sell your Bitcoins for actual like US dollars that you could then wire out into a bank account. But for the most part, Tether itself was the first sort of crypto native stablecoin which you can just hold in independence of actual US dollars in a bank account. You can actually just hold them as their own stablecoins issued on the network. So they were issued on Ethereum, and also recently, they've sort of they're issued by BitMEX, which is an exchange, and then they were deployed on Ethereum and a bunch of other crypto like actual networks themselves, and they really have their own. There was a first effort into creating their own native stablecoin. As a result, Tether was sort of the majority player when it came to stablecoins in the sort of 2017 ICO era, when you saw a lot of trading of these tokens against stablecoins. But Tether itself has, of course, you guys might have heard, sort of its own scandal surrounding it. At the end of the day, they are a centralized company that are issuing, they hold the reserves or the deposits in bank accounts, right? So, well, they hold reserves in sort of corporate entities, I'll just say that. And as a result, right, more of their sort of stability or the collateralization model is dependent on real-world assets that are really not verifiable. During the time, it was sort of an accepted operational model because in 2015, there was really only a few good crypto exchanges, really not many at all, and there was no real way to actually have on-chain value in terms of collateral because it was all volatile and it was also itself sort of questionable in terms of the stability and sort of the long-lasting, like confidence of these projects, right? Like in 2015, when Ethereum just launched, you really couldn't know if this was going to last a year, 2 years, or like 50 years, right? It was still a very upstart project that had a lot of growing pains with the way people could actually write code and contribute to the network. As a result, one of the sort of big advances of Tether is offering that price stability in a cryptocurrency token itself as like the first stablecoin. It wasn't the first stablecoin that was thought of, but it was the first one that got wide adoption, just a clarification. But as a result, people have also said that Tether itself, they don't like the practices of Tether. But again, it's one of the most widely integrated stablecoins in crypto itself. They do kind of have, you could maybe say, sort of an outdated or more like this era of, it's like an older era of cryptocurrencies that really were king in. But they still hold the largest market capitalization by circulating supply, if I recall correctly. Although USDC is not far behind. But yeah. In terms of actual crypto native stablecoins, MakerDAO and DAI was the first project to actually do something with this space. So MakerDAO itself is a stablecoin platform that's pegged to pegged to Ether. Sorry, very important distinction. Ether being the native currency of the Ethereum network, right? So Ether being the native token of the network gets the advantage of being decentralized because the network itself has an open protocol with open issuance rules. That's everything that's defined programmatically. And also built open source on GitHub, et cetera, right, on forums online. And they create a token called DAI that's collateralized by this ether through lending positions. You can lend your Ether out to generate DAI. As a result, the DAI stablecoins are really just $1 units of debt, of debt that are counted against the base Ether collateral that is backing it. As a result, if Ether price goes up, more DAI can be printed. If Ether price crashes, then the DAI must come back into circulation, or else the Ether itself, located in Maker, will be liquidated to other people who will then sell it and trigger sort of in a black swan case or in a worst case bank run case, it would trigger sort of a cascade of liquidations, further driving down the Ethereum price, which is why it's actually quite important for the ecosystem in general to have some sort of coordination in case of black swans, to like kind of look at these things as systematic risks. So one of the things is that you have these different mechanisms, you have these different systems. You never oftentimes are able to remove systematic risk. You just push it elsewhere. This is a really important distinction because we kind of, when we design things from an idealistic perspective, might not be considering where the systematic risks are. We might just try to be eliminating them from a design perspective, but oftentimes, if you don't take into the hard reality that there are systematic risks when it comes to these giant coordination mechanisms, such as currencies, you oftentimes just design your systematic risks outside of the visible view, and then when it comes calling, you're not even ready for it. So, just one kind of caveat on system design when it comes to these things. One of the issues with MakerDAO, obviously, is the inherent market volatility behind Ether. Again, like I mentioned, if Ether's price crashes, MakerDAO itself, the DAI token itself is dragged down by the pegging. MakerDAO is the DAO that runs DAI and issues DAI, so it's the participants in the set of contracts that issue DAI. To counter this volatility with on-chain lending, right, because this is, again, a new setting. This is not like you going to your bank and issuing a mortgage. This is you creating a loan on a blockchain where no one actually knows you. You have to over-collateralize all your loans. So instead of getting 100 ETH worth of DAI, you only get like 50 ETH worth of DAI, or actually 2/3. So you have to collateralize it by 150%. You only get like 50 ETH worth of DAI when you deposit 100 ETH, right? So whatever the ETH market price, we'll just round, say if ETH is $1,000 today, you deposit $100,000 worth of Ethereum, you only get $50,000 of DAI, so 50,000 DAI itself, when you create this collateralized debt position, because in the case where the value of the ETH crashes by like 60%, and you hold the DAI, but now your ETH position is in jeopardy because it's under the liquidation price, there's no way for the MakerDAO system itself to come and actually ask you for the rest of your money, because for you, being a participant on the blockchain, you have no real-world ties to it, at least directly, right? As a result, there's no way for any like repo man to come to your house. You just turn the computer, you shut the computer off, right? So there's no way to actually, this is why things had to be over-collateralized on the blockchain, because you can just log off, right? And this is pretty important. Anyways, so when we move into actual sort of new designs or like novel designs of stablecoins that are using sort of a different mechanism, the sort of first attempt at an implementation was done by Basis. So Basis Coin was actually a project that was founded in 2018. They raised a lot of money, but they didn't actually get to sort of release anything. It's a kind of a different story, but in Basis, there was an idea to use the senior shares model, which was actually a paper published by Robert Sams, who worked at BitMEX back in 2014. Again, you kind of see some correlations. BitMEX was is the issue of Tether. The guy wrote a paper who was working at BitMEX about a new stablecoin model in which you could have a sort of second token, in this case a senior share token, that's used to help control the monetary supply. In the senior shares system, when the coin price drops, the shares are auctioned off for coins, destroying the shares in the process. Destroying the stable coins in the process to, again, reduce the supply of the stable coin to match the new demand, which has a lower price, to thus equalize this price. When the coin price rises of the stable coin, the coins are auctioned off for shares, so people who hold shares are now issued, or they sell their shares for new stable coins, which brings the supply curve to the right, increases the supply of the currency, and then brings the price point equilibrium back down to $1. So it's a very novel, it's a very creative, unique, and well-fitting mechanism that is extremely kind of potent and is a really great idea. Basis itself was just a project that tried to use this currency, or use this idea, and they didn't actually launch, but yeah, it's a different story. So just to kind of look at this itself, the Basis model had something where they had a third token called bonds, which really wasn't necessary in the crypto economic setting, because you really didn't need to have debt as the sole generator of credit. In the US, right, like the credit, mortgages, all that's fun, like small business loans. This is funded off of deposits at bank, right? These are depository institutions that lend out the money through fractional reserve banking that funds all the other, like parts of the economy, right? So when it comes to the actual like monetary supply of these things, bonds are a core component of central banks because they create their credit through depository institutions. However, in an actual crypto economic setting, you don't actually need the bond token, because the bond token itself, being sort of a counterbalance to whatever interest rate you're offering from the central bank itself, not being as necessary because you don't actually have the lending as a creation of credit. You actually have the minting of stablecoins, or the collateralization of your system through the deposit of another stablecoin as sort of the core wealth, the credit creation point. As a result, they sort of had somewhat of a misaligned model, but it still worked. The important part here was that they had the share token and the actual Basis coin, the stablecoin itself. As you can see, you can combine bond and shareholders for what they were trying to do. When there's more demand for the currency than supply, more of the tokens are issued. In this model, the bondholders are effectively receiving the newly printed currencies as their bonds mature. Again, right, on the other side of things, if the central bank, as the central bank issuing these bonds, you do this as a monetary supply tool such that you can counterbalance whatever projections you have with the interest rates you're already setting. If your interest rate are at 2%, you probably have to offer maybe 3% in treasuries, right, to get people to actually buy these things. You can model how much people will buy based on the current, financial models you have. It's important, right, in that setting, in this setting, the shared token is what we care about, because it itself is sort of it's the future sort of management of the supply of the currency, which is the interesting part, which is why you have a shared token, which in cases of deflation can be printed such that it'll remove supply of the stablecoin itself from the circulating supply and bring the price peg back to $1. Again, the core mechanism here is we're trying to keep the price of the stablecoin at $1. That's the whole point. That's why people will trust you, and that's why people, will use you in other parts of their systems. So you can see the collateralization. Supply goes up, the token goes to the bond and shareholders. Supply goes down, they have to issue new bonds or shares in order to retract the token supply to the token holders. Just one other kind of way to look at things. And one thing we did with Frax when we started this thing was we looked at the senior shares model as precisely like a great starting mechanism for stablecoins themselves, specifically algorithmic stablecoins. However, when you look at the bootstrapping phase of a new currency or a stablecoin, and the reason why SDR, special drawing rights, are important at the IMF is that you need some sort of collateralization or faith in your system in case you reach any economic shocks, right? As a system matures, it's much easier. You sort of go from a 0 to 1 phase to a 1 to 100 phase, right? As a system matures, it's much more it's much more resilient against economic shocks. It's usually oftentimes bigger, more trusted, more well integrated, deeper connections that help it sort of become systematic risk instead of isolated risk, right? But from the 0 to 1 phase, you need some sort of way for it to actually survive any economic downturns such that it would affect the whole stability of the system itself. As a result, having the fractionally collateralized model where you start off with 100% collateralization, with starting off with USDC as the way to mint it, but then adjusting it over time algorithmically through a collateral ratio such that it can trend towards algorithmic depending on market settings is actually what we did, and is actually one core mechanism which why we actually worked when all these algorithmic stablecoins didn't work because they had no collateral. If the market starts to crash overnight and people get afraid, there's a bank run, if there's no guarantee on how much collateral is in the system and it's fully algorithmic, it can expand faster, but as a result, it contracts faster, and as all we know, when things start to fall apart, they really start to fall apart quickly, right? As a result, stability is important. We're doing well these days at 1.3 billion, so it's a good stablecoin. But again, right, the core mechanism here is that you have the algorithmic portion, which is unique, novel, important, and innovative, and also the collateralization mechanism, which really ties it back to reality with the efforts of what's what the real performance of these things in real-world systems. As a result, I put the logo in the middle. As you can see, this is, again, on the top, there was these non-collateralized, or as they're now referred to, algorithmic stablecoins, which have their different models. There's crypto collateralized here in the maker model, and there's fiat collateralized here in the sort of, the tethered model. The Frax, you can kind of, in a certain way, you can say it's somewhat in the middle because it gets the best portions of the algorithmic part, but it doesn't actually go too far. It has some fiat collateral that's represented by crypto tokens, so it really kind of combines the operational models of these three to get you something that is actually able to perform with the benefits of all these, and as a result, get you price stability, but also algorithmic monetary supply, and the actual governance contracts run on chain that fit together for the whole system. And yeah, just to wrap up, you can see over the past 2 years, there's many new stablecoins. I actually had to put a couple of X's on these since the graphic was actually first made. But as you can see, there's been a lot of casualties. A lot of these stablecoins don't actually work. Stablecoins are extremely difficult to actually make properly because it turns out most people aren't really, central banking is a different skill. You can look at some of these models that, by the time I wrote this, Terry already had the triangle around it, but we kind of see the writing on the wall. You look at some of these stablecoins, and some of these actually, some of it was just execution that didn't work, some of it was flawed monetary policy, and some of it was just anyways, as a result, right, the sort of most stable economic systems or most stable coins oftentimes, and just in general, most successful projects will actually combine parts of innovation, but also parts of currently working real-world tested systems in a specific blend or in the right blend such that they actually are able to adopt innovation without destroying themselves in the process. As a result, you get this chart, and as we see this next graph, this is actual stablecoin supply since 2017. Huge boom, right? These are hundreds of billions of dollars of stablecoins now. Well, actually more like 150 billion, but as you see, right, this was taken today, the screenshot, you can see the sort of stablecoin supply as a function of the market. when the market's heating up, stablecoin supply actually increases. This is because people take their fiat, which is where this supply comes from, right? These are dollars being held in bank accounts, goes into crypto in the form of stablecoins. When people deposit their fiat currencies, wishing to buy like Ether on chain or whatever, they say, okay, my money will be in crypto dollars instead of bank dollars, right? When the sort of crash happens, or when people want to use money back in the real world, they'll just deposit. They go back the other way, and they say, okay, if they have stablecoins, they will just take it off, off their wallets, put it on exchange, cash it out for fiat, destroy the supply of the destroy the stablecoin, then just redeem it for dollars in their bank accounts. So you can kind of see this pendulum. As a result, all the bull market growth that happened in 2020, 2021, and 2022 sort of reaches a peak. And then there's people who are just essentially, well, I mean, there's one collapse, but there are also, like, as you can see, the lowering supply of USDC as a result of actually people putting the money where it's more valuable. In this case, they would believe that, and for USDC's case, they want to put in their bank accounts rather than on chain, which makes sense if you look at actual like today's rates of lending, farming, and treasuries. Treasuries are becoming pretty attractive. Hey, like it turns out, like 2% yield is not bad when you have sort of a lot of, but anyways, rates are increasing, right, in our sort of economy to help combat inflation. As a result, the U.S. Treasury doesn't actually issue treasuries on chain, although it'd be cool if they did. They issue treasuries at Federal, like Treasury Direct, so you'd have to actually put your money into a bank account, wire it through fiat, get it out through ACH, and then you get it into a T-note, or you have your bank do it. As a result, the stablecoin supply has shrunk a bit in the past year. And then, as with all things cyclical, we'll see you guys the next time around. So it's a good kind of segue. Next week, we'll either focus on lending, some on-chain data, et cetera. We'll kind of create the topic as it comes. Please fill out today's survey if you haven't already. Thank you if you have. Let us know how today's presentation went. And then thanks to Will for the feedback, for getting a bit too technical. Also, thanks Brian for the reminder. If you guys want a lecture schedule, we'll try to get something going. Although we do take these things kind of by ear, depending on how the previous weeks go. We don't want to get too sort of deep into one direction and then not be able to pivot. So we see sort of these things on a week-to-week basis. As a result, we're able to best respond to what you guys are interested in, what you guys like, and what you guys came here for. So thank you guys all for coming. It's a great week. If you guys want the presentation slides, they'll be uploaded to the Discord shortly after the meeting. They'll be it for this week. Thank you.